Look, I'm talking about Gokaldas, 15% higher, 15.5% higher. I mean, the stocks galloped to 700 rupees plus. Now, the company has entered into an agreement to acquire Dubai-based Atraco Group for $55 million. This acquisition will be funded by a mix of debt and internal accruals. Shiva Ganapathi is with us, Vice Chairman and Managing Director at the company. Shiva, good to have you with us here. Good morning. Thanks very much for joining us. Prashant this side, congratulations on what
so much,
clearly
Prashant.
seems to be being taken very well by the market and very complimentary and a meaty acquisition for you. We'll get to how you're funding it, etc. Although, I mean, looking at the reaction, I don't think the market's too bothered with it. They think you'll manage it. So let's talk about the idea behind the acquisition, what it brings to you for Gokaldas, and what was the thought? Because I believe there are some advantages of being able to export out of the manufacturing facilities of this company, which are in UAE, Kenya, etc., where export duties into the US are not there, unlike exporting from manufacturing facilities in India. So just take us through the rationale and what this brings to the table for Gokaldas.
Okay. So the company, while it's headquartered in UAE with all its corporate functions and marketing and every product development, etc., out of UAE, the manufacturing happens out of Kenya and Ethiopia with larger presence in Kenya. There are 4 factories in Kenya, 1 in Ethiopia. Kenya goes duty-free into the US. Ethiopia used to have a duty-free access, but for now it has been temporarily suspended. It's likely that it will be restored. Ethiopia also goes duty-free into Europe. So that way, the acquisition gets us a low-cost location for manufacturing. It gets us a high-quality manufacturing asset because these factories have been around for decades. So they are very, very well-run, very efficiently run operations. And we get a running business, and above all, a duty-free access to key markets. So from all of these standpoints, this becomes a very complementary and value-adding asset for us. And that's one of the reasons why we went ahead and acquired it. It's very well-run. Management is very strong, quite profitable as well. And we see a lot of synergies between us and them, and which is why we went ahead with this transaction.
Well, good morning, Mr. Ganapathi, and congratulations. This super transaction, if I look at it on the base of last year, it's adding more than 30% of revenues and more than 35% in terms of profitability. So well done on that front. But let's understand a couple of numbers now. Going through the release, we have the PAT margins. But could you tell us what was the Ebitda margins of this acquired entity? And also, how do you see, what is the peak revenue potential from here on, from the current revenues of close to around $107 million?
So there is, the EBITDA margin is about 10.5% at the moment for the company. And we believe that, after we take control of the company, post all the regulatory approvals, we will have an opportunity to work on improving the EBITDA margin over the next 2 to 3 years. We will also be investing in the plant and machinery, modernization, etc. So all of that will happen as we move forward. In my opinion, this particular asset itself, we should be able to grow by about 25-30% in the next 2 to 3 years. That's the intent with which we are coming. Eventually, all of Gokaldas, we would like to grow at about 20% YOY. And I think this becomes a very important, tool for us to maintain our growth momentum. But this asset itself, as I said, we will have a fairly good upside going forward. In my opinion, at least 25% going forward.
So from $107 million, it can go to what extent with the minimum capex that you have? Can it go scale up
about 130 odd? So that's about 25 odd percent. 130 plus. Yeah.
Okay, so 25 to 30% growth in the next 2 to 3 years for this acquisition, and 10.5% EBITDA margins currently. You have the opportunity to improve EBITDA margins further. Got that. Mr. Ganapathi, good morning. Now, if you can tell us about the balance sheet, what is the kind of debt that you will take on to fund this acquisition? And what is the balance sheet of Atraco itself? I mean, how does, any kind of incremental debt that you take on post it?
So the company only has a working capital debt of about $15 million, Atraco itself.
Okay.
And we will be, funding it by part equity, part debt. The debt that we will take to fund this acquisition would be about $40 million. So and I think we have the sufficient cushion, and our leverage ratios are at this point negative because we are sitting on over 400 crores cash, about almost $50 million at this moment. So even with the debt funding, I think we should be fine. We have the balance sheet strength in Gokaldas to fund this asset ourselves.
So by the end of the year, you will be sitting on $40 million of debt, right?
$40 million of long-term debt, which will be used to fund this asset. Yeah, fund this acquisition.
Okay. And what is the current utilization level of this company?
This would be at about 88%, 89% thereabouts. Yeah.
Okay. All right. Give us a few more details then, sir. Since it's headquartered in Dubai, the effective tax rate will be lower as well. Is that correct? So they get a benefit out there besides getting a low-cost producer with entry into the US markets. The taxation will be another positive.
That's correct.
Okay.
That's correct.
All right. Just going by these rough numbers, I think Gokaldas, prior to this acquisition, the peak capacity would be around 3,500 crores, taking into account the capex as well that you already have, around 3,500 crores?
Yes.
All right. And I put this together as well. So, in the vicinity, say by 2025, the peak revenue potential for Gokaldas will be in that vicinity of around 4,500 to 5,000 crores?
That you're talking of calendar 25, FY25, FY25 is too short.
FY25. FY25, taking into account this acquisition as well, plus the capex that you have, revenue potential goes up tremendously. I'm comparing that with last year's revenue of 2,200 crores. So by 2025, you have a potential revenue doubler. Are we getting that correct?
Well, it all depends on how the market conditions support us. So that variability we are dealing with. We are seeing fairly good traction in the second half. So yes, a strong revenue growth. Definitely, we are on track for that. This acquisition allows us to get there. Whether it will double in 25 or 26, I really don't want to comment on that.
Mr. Ganapathi, peak revenue potential, just want to understand the potential.
Yeah. So potentially, we can go towards 3,500, 4,000 crores, that kind of revenue. That potential exists. It all depends on how things pan out, right?
3,500 crores to 4,000 crores by FY25.
No, I mean, you have to be a little more generous with the timelines. No, 26 perhaps.
But broadly, without getting into those numbers and all, because it's far out and we don't know exactly.
Exactly, and market conditions. There are too many variables here, right?
Variables. Yeah. But 20-25% is what you'd like to grow the combined business. Is what the aim is.
That's right. 20% combined. Yeah.
The margins, when you said you had the opportunity to improve, you would have kind of assessed what are the improvements you can get to, and where could margins for the acquired asset go up to? What could they go up to? What's the?
It's a bit early to pin a number because we have to get into the company, get to know all the nuances and details, etc. To be fair to them, they are very well-run company as well. So, but as usual with growth and with operating leverage, I always feel that there is a good scope to increase margins by 1.5% or 2%. That I think should be there. We will discover as we get into the asset soon.
Okay, just two quick questions, Mr. Ganapathi, if you can help us. One, what is the kind of geographical reach that you will get with this acquisition, and what will that take your contribution to? Because currently, I think 85% of your business comes from North America. And two, any more such acquisitions that you're scouting for since you have cash on your books?
Okay, so this one will also add more of North America to our geographical reach. This asset exports 95% of its output to USA. So that's because it gets duty-free access to that region. So our weightage to that region will only continue. Probably it will increase up a notch. So that it is what it is.
Since 95% goes to the US, what are the kind of retailers that they cater to? Currently you have Walmart, H&M's, Gaps of the world, but what are the other customers that you would get access to?
they also have a similar profile, high profile, good customers that they have. The good news is that it's complementary customers. There's only one customer in common. Otherwise, all the customers that they have are different from the customers that we have. So we probably will also have some degree of cross-selling opportunities going forward.
Okay.
Okay. Any more such acquisitions?
Well, we have to take one at a time. I don't think we will, extend ourselves by doing multiple things simultaneously. So let's deal with this one first, and then figure out the next move.
All right, Mr. Ganapathi, appreciate you joining in and filling us in with all those details. Congratulations on a very, very good acquisition. The street likes it. The stock is locked in upper circuit. I'm only wondering why the seller sold at less than 8 times PE. But good for you, good for your shareholders. And in fact, the stock market has appreciated it as well. For the time being, though, we'll slip into a